Welcome to the 2026 Global Market Instability Report. The first half of this year has been marked by an extraordinary confluence of macroeconomic pressures and geopolitical tensions, resulting in the highest sustained market volatility since the 2008 financial crisis. As you can see from our key metrics, the global VIX has surged 38% to an average of 46.2, while the S&P 500 has seen a sharp year-to-date drawdown of nearly 18%. This instability is driven by 5 primary factors: persistent inflation exceeding targets by up to 200 basis points, escalating global tariff disputes, credit stress within commercial real estate, energy price uncertainty from geopolitical friction, and a significant valuation correction in the AI sector following the peak multiples of late 2025. Looking deeper into the volatility dynamics, our global volatility index breached the critical 40-point threshold, a historical indicator of systemic stress, as early as March. However, the impact across sectors has not been uniform. While defensive sectors like utilities and healthcare have demonstrated relative resilience, growth-oriented sectors have borne the brunt of the sell-off. Most notably, the technology sector has undergone severe multiple compression. Investors are aggressively repricing growth assumptions as they adapt to a higher-for-longer interest rate environment, moving away from the AI-driven euphoria that defined the previous year. This volatility has triggered a massive migration towards safe haven assets. We are seeing record-breaking inflows into gold, which has climbed to over $3,200 per ounce, as well as short-duration U.S. Treasuries and Swiss francs. Conversely, emerging markets are facing sustained capital outflows due to a strengthening dollar and rising debt servicing costs. Looking ahead to the second half of 2026, our risk scenario matrix identifies 3 paths. While our base case sees a potential moderation of inflation and a late-year Fed pivot, we must remain vigilant of a 35% probability bear case where a deepening credit crisis could drive the VIX as high as 65 and further depress the S&P 500. To navigate this uncertainty, we recommend a disciplined strategic approach focused on resilience. This includes diversifying into real assets like commodities and inflation-linked bonds to insulate against equity drawdowns, and increasing hedging ratios through protective puts or VIX call spreads. We advise overweighting quality companies with low leverage and strong pricing power while reducing exposure to illiquid private equity positions that face mark-to-market pressure. Finally, maintain a close watch on central bank signals, as any shift in rhetoric from the Fed or ECB will be the primary catalyst for a market recovery. Strategic positioning around these key dates will be essential for managing portfolio liquidity and capturing upside when conditions eventually stabilize.